Hello folks, and welcome to yet another edition of The Wealth Doctors. Happy holidays to everyone. I'm joined here today by brother and my smarter brother and Chief Investment Officer, Jonathan Camarda, our Director of Financial Planning, Troy Lerche, and Dr. Veronika Pell, Director of our Tax Operations at Taxmaster. And I want to begin, really, the markets have popped very nicely over the past few weeks. Yesterday, the Wall Street Journal declared the bear market is over, though we're still down substantially. And I kind of want to give you some context for how we're looking at the markets and making decisions. A very wise person, happens to be my wife and partner, Kimberly Camarda, is fond of saying that we invest not on what should be, but what is. So to begin with, and I'll ask Jonathan for some commentary, one of the indicators that we watch, fairly regularly, and this is as of December 1st today, is declaring that U.S. equities are still in bear phase, not, the number of, where they're down from the peak, but in terms of what the charts look at, going forward. International still in bear phase, resource and materials, commodities still in bear phase, real estate bear, bonds and fixed income in bear, and of course when rates go up, as they inexorably are, bonds go down in value, and also U.S. equities, the quarterly trend indicator is negative. The shorter term indicators that we look at occasionally are still showing U.S. equities positive, which makes sense because they've been on a bit of a tear lately. So Jonathan, with respect to this, and I know you look at many other more sophisticated indicators in guiding your decisions as chair, tell me what the markets look like to you.
Yeah, so what we're looking at here is exactly like you talked about. It's a short-term pop within a well-defined downtrend. So if you look at the charts, imagine a zigzagging saw going down, and each blade goes up to a lower level. So the recent pop that Jeff referred to is a lower high than we had previously this year on rebounds within a well-defined channel. And you saw that just a small caption. Yesterday had a nice pop on Uncle Jerry's comments, and then today, of course, the market not down hard, but down. So, and a lot of optimism that you're seeing out there. As you mentioned, technically is not supported just yet.
Well, good. And thanks, by the way, for keeping those sentences short, like we talked about.
Vacations help.
And then kind of, the translation is, market, a down market is defined by lower lows, lower highs, lower lows, sawtooth, as Snaggletooth Jonathan just shared.
Right here.
And so it still looks relatively dark to us. So the next thing that, and we'll expand on this in a little bit, and the segment I'll talk about now is in the news, right? So the biggest news of the past week is this really amazing, civil disobedience uprising that's happening in China. Really just astonishing what's going on there, with very, very significant ramifications potentially for everything from the geopolitical stability and safety of, avoiding, tensions and flare-ups, and also China's ability to compete economically, do well for its people and supply goods around the world. So that really is wild. The other, probably more important aspect from an investment standpoint is inflation peaking? There's been a lot of news that I think the UK's inflation, it's down from 10.8 to 10.2. U.S. numbers a little bit lower too. And I think that fact is a big reason that the U.S. markets have rallied so significantly. Oh, the worst is past, inflation's coming down, the Fed's not going to be as aggressive raising rates and so forth. But let me ask you a question, Jonathan. Do you think you think inflation has peaked, is coming straight down, or maybe it's plateaued at still unacceptably high levels?
Yeah, so I think absolutely. So again, it's all relative, as you mentioned, with the market, in the such that it has come down. We're seeing some of the numbers that are a little bit lower than we've seen, but as you mentioned, the fever is still above where you'd want it to be. So it is more of a shade of gray, right? This isn't your typical economic cycle, like we called, I guess back in June, Jeff.
We called a recession months ago,
it's a rolling recession.
You mentioned just this morning that we're deep in it. A lot of folks don't realize it, but we are.
And a lot of the large hedge fund guys and gals have already come out and talked about it's going to be a hard landing. Jerry knows that. That would be Jerome Powell, excuse me. But yeah, absolutely. Inflation is still, once it gets out of the bag, and that's why some of the policies won't get into the details. That's not what this is about. Once those are let out of the bag, like you said, and you intimated even in this morning's meeting, which was pretty salient, is that it is very hard to get that proverbial nail back in the wood. In other words, once inflation is out, it's a demon to try to catch. But like you also mentioned, in doing so, you're chasing a fly with a hammer, and you might hit yourself in the toe, and that would be the recession, and it's inevitable in this case.
I think it's already happened. In fact, one of the Fed governors, I forget which one, was saying until we get softness in the labor market, we're not going to be able to get inflation under control. The translation to that is massive layoffs and people out of work, where incomes, where the cost of labor goes down in order to abate inflation. So from our perspective, this current market pop notwithstanding, the sky is still pretty dark going forward, and we're anticipating that the bear market's not over and further pain ahead. So those of you that are invested heavily, probably not at Camarda but elsewhere, might want to consider, is this a good opportunity to maybe get into a safer position before that might happen if it does. But again, to wrap this market segment update, as Kim says, we invest not based on what should be, and what should be is the market should go down driven by higher interest rates and inflation, but what is. And if our charts turn up and the indicators look like we're going to be back in bull phase, we will invest appropriately regardless of what should be. So the next thing, very briefly, I'd talk about a segment I'm calling direct from Georgetown, where I'm laboring under the 4 yet final exams before Christmas, is beware the skip tax. Right? So we do talk a lot about estate planning, and most folks are familiar with the estate tax, that if you die worth more than a certain amount, which is coming down dramatically in a couple of years, you have to pay 40% of the amount over that, that line, which would be $6 million per person at the end of 2025, I think. 40% of that's got to go to the government. There's another tax that's really not well appreciated by investors called the generation skipping transfer tax. And that's say that if I, as you can tell, I'm starting to get much longer in the tooth, and let's say Troy here is my grandson, my beloved grandson, and because I've got enough money, in order to avoid paying estate tax, maybe I'll just give the money directly to Troy, I would think, and I'll skip a generation and give it to grandson. Unless you're careful and plan wisely, you would wind up, if you're worth enough, paying not only the estate tax, but basically a second estate tax called the generation skipping transfer tax, which is like most of the money. The tax rate approaches 90%. I'll go back and look at my notes, but it's like most of the money. And this is the danger looking that most affluent investors are simply not aware of. It's very, very manageable if you know what you're doing, which is one of the reasons we've assembled the Crackerjack legal team, I think, and I'm in law school in my 60s, in order to have the tools to help you control this. So that beware the generation skipping transfer tax. So let's switch to maybe some tax talk. And Troy, some of the things that you're discussing with clients this time of year are capital gains or capital loss harvesting. Good time, good year to do that, right? And required minimum distributions and Roth conversions. Would you like to expand on some of those areas?
Yes. So the first one you mentioned was tax loss harvesting for some of the positions. What our strategies, and Jonathan has been great about it this year. As we've seen the markets,
Just to lay that out, if I can interrupt you, that's where, okay, if I've got, ABC that, I paid 100 for, and now it's down to 60 or 70, if I sell that, I'll get a loss I can use to offset gains and save overall taxes, right?
Correct.
Okay.
Yep, thank you. So we've been, we're actively doing that in the portfolios. Jonathan's done a great job this year, and we've been able to capture that for our clients. And that's just, that's something that we do, and at the end of the year, we make sure if there's any other opportunities, that we would execute additional trades to capture losses for the year so we can offset gains.
Yeah, so Camarda clients and others that are watching, this is a particularly good year because the market had floated up into space during COVID, has come crashing down still at these levels this year, and it might be a real good time to make some change in the portfolio, not necessarily change your overall exposure, but if you sell ABC and you buy DEF, which has got similar market performance to ABC, you lock in a tax asset but still keep your market exposure, right?
Yes,
so talk to your wealth advisor, or whoever, if you're a Camarda client, we're doing this for you. If not, please ring our bell, but if you're not a Camarda client, it's a real big opportunity. Let's go to maybe Roth conversions. That's been a popular topic this year, again, because the market is lower. What's the nuts and bolts of that, Troy?
So with Roth conversions, what you're trying to accomplish is, it's a bracket arbitrage type game. And what that means is that based on your income, your tax preparer can help you gauge how much additional ordinary income you want to recognize by converting pre-tax traditional or rollover IRA assets into a Roth conversion for the future benefits of Roth IRAs being tax-free later on.
So let me see if I got this right. So if I got in a regular IRA, then, of course, I know I got it right, but you have to make it more clearer. If we have a regular IRA that's all pre-tax money, every dollar I take out of there, I got to pay tax on what my tax rate is. If we convert it to a Roth, and most of you know this, it's tax-free, so you got to take it out, pay the tax, put it into the Roth, and then it grows tax-free, for the rest of your life, pretty much. But the trick is you want to get out at a lower bracket than a higher bracket, right? So if you're paying 40%, then maybe that's not such a good deal if you're going to be a 20% bracket later on. So the keys are how much, to get into the nuts and bolts, how much additional income, the tax pros call it ordinary income, do we want to recognize this year without getting into a much higher bracket?
That's correct.
And the devil's in the details, right? We won't know this for you. Your financial advisor typically won't. It's a tax preparer question, unless they're tax master clients that where Veronika and her team prepared, then we have the information internally. So you kind of got to do a pro forma, take a look at, gee whiz, how much income do I already have this year? What bracket am I going to be in? How much more can I stand before getting into an unacceptably high level? Right. It's not that complicated when you look at it that way, but that's what you got to do.
That is correct.
Any other insight from that, tax pros?
Nope.
You know, and the other considerations are, obviously, if you do it when the market is down, that's a good time, right? You can squeeze more assets out, you know, for a lower tax value. But also think about what your tax bracket may be going forward. Are you going to be retiring next year and your income comes way down, which we should tell that lady we talked to yesterday to consider this, because maybe you might want to wait a couple of weeks and do it in 2023, you know, when your rate will be lower because your overall income is lower.
Absolutely.
All right, good. Any comments on our required minimum distributions?
You know, the only thing now what we're doing is, you know, once you reach age 72, you're required to take a certain percentage out of your retirement assets of traditional IRAs, and the deadline is the end of December, 12/31. So we've been just working with all of our clients to make sure we get it accomplished by the end of the year, and we work directly with their tax preparer for federal withholding, or if they are tax master clients, we work with Veronika, and we just make sure we get it done for them by the end of the year, and the withholding is appropriate for their fact pattern.
Yeah, and another comment though, you know, and not all financial advisors may be as savvy on this as I think that we are, but there are a variety of different formulas that you can apply to minimize the RMD, can't you? Are there different ways to calculate it? You want to customize it, you know, for the client to minimize their taxes?
Well, yeah, the calculation itself is pretty straightforward. They take the previous year's balance and divide by a life factor, but that's in itself not as straightforward, and there are other ways to minimize tax by qualified charitable distributions. You know, you can, if it's your first year RMD, you could delay it to the next year by April 1st. So, but it really, you know, every client situation is different, and we really have to focus. If we're doing their taxes, we dive into it, but if not, we work with their tax preparer and we make sure we do the best for them.
So you have some dance room,
yes,
as you mentioned. All right, good. So the last thing, and I know we're going a little long. Again, happy holidays to all of you, by the way. If you notice, I've worn my mistletoe tie in case anyone wants to kiss me after the taping. Oh, come on, Sonny. Is to talk about, you know, some tax opportunities. And one thing I want to read really fast, you know, for our business owner viewers out there, and this from the Wall Street Journal, I think, you know, the Paycheck Protection Program, PPP, and other federal aid programs long ago shut their doors, but small businesses and nonprofits battered by COVID can still use a lesser-known technique, the Employee Retention Tax Credit, or ERC. Businesses can claim up to $26,000 per employee in refunds by amending payroll tax returns from 2020 and 2021. It's not too late to do that, by the way. For businesses that qualify, the ERC offers a welcome cash infusion, as owners may be struggling with inflation, rising interest rates, and tight labor markets. One payroll processor said it helped about 45,000 clients secure more than $9.2 billion in ERC claims. There are many that just don't understand they're potentially eligible for this, and we're slowly but surely working through them. Smaller employees could get a refundable tax credit for paying active workers, which is it's great, right? It's like more free money to cover your payroll. Up to $5,000 per worker for 2020 and $7,000 per quarter for the first 9 months of 2021. And businesses, again, typically have 3 years to amend their returns, so you're not out of time yet. To qualify for the ERC, employers must show a significant decline in gross revenue from 2019. They can also qualify if they experience a full or partial suspension of operations because of government orders, or New Yorkers, are you listening, or were hurt by supply chain disruptions caused by COVID-related government orders. And that's really just, you know, an example. I mean, tax is so complicated, which is why I call it the master wealth skill. There's so many ways to convert avoidable taxes into personal family wealth if you know where to look. And in our opinion, most tax preparers simply don't have the knowledge base or the gumption to do that. Veronika and I were talking about a new client. I think this has been a client of ours for about a year now. Successful business owner that you were able to save $100,000 in taxes. Obviously, they are a little bit more than $100,000. They were tickled pink. Can you share with us, Dr. Pell, what magic you worked with this client to save so much money?
So based on the Supreme Court decision, we added to the basis of the client's property his attorney fees, legal fees, and other professional fees, which increase his basis in property and decrease his income tax.
So let me get this right, okay? So in terms of depreciation, most business owners know you can depreciate assets. And his past tax preparers, I guess, overlooked the opportunity to increase the basis, to get to depreciate additional value based on tax law that stems from a Supreme Court decision, right?
But you have to know that you can add legal fees, professional fees to the basis of your property only if you use that fees to obtain that property or to protect that property.
Mm-hmm. Yeah, so and that was about $120,000 you saved, or something like that?
Yes.
All right, and all of that was just from increasing depreciation.
Right.
Now, were you able to accelerate that? Is it worth amending returns, you know, to apply that higher depreciable base in prior years, or we'll just get the rest of it going forward?
No, the client got extension because of the hurricane, and we can file his tax return by February of 2023, so he used that opportunity And we just got calculation from his previous CPA. We went through and they figured out that he didn't use a lot of the opportunities. He didn't use upgrades and improvements. They just forgot about that. They forgot to add these professional fees. So when we calculated all together, we got like more than $100,000 savings.
Good, good, good. So, and that's just one of many opportunities. I know this client well. One of many. We kind of got the tax work late in the year, so we'll look at some even bigger opportunities for next year. But that's just great. I mean, that's $100,000 plus, like waving a wand, just because you got to look at the facts total and apply the law properly.
And the coins in the couch.
Yes.
Yeah, or the gold bars under the couch,
Yeah.
and I got to tell you, folks, especially for business owners and real estate investors, and frequently for stock market investors, we see opportunities like this all the time when we review tax returns. But I suspect that we're nearly out of time. Is anything else that you folks want to share before camera person Megan wraps it up?
No, just happy holidays and Merry Christmas, and appreciate your trust.
Good. Happy holidays, Merry Christmas, Happy Hanukkah, Happy Kwanzaa. Is there anything I've forgotten? What was that Costanza's father had? Was it with the pole? I forget. Festivus, right?
Festivus,
And
yeah.
happy Festivus to one and all. Thank you.
Thank you.
Bye-bye.